Business valuation terms explained. Simply, if you're building, investing in, or valuing a business, you'll hear certain financial terms repeatedly: pre-money, post-money, revenue, EBITDA, enterprise value, equity value, pre-revenue. These terms are often confused, and misunderstanding them can lead to poor valuation decisions. In this video, I'll explain the most important valuation terms clearly and simply so you can use them confidently in fundraising, negotiations, and financial discussions. We'll break them into 3 categories: valuation terms, revenue and profit terms, and company stage terms. Part 1. Valuation terms. Let's start with the terms directly related to valuation. Jagrisak pre-money valuation. Pre-money valuation is the value of a company before new investment is added. If an investor agrees your company is worth $4 million pre-money, that means the company is valued at $4 million before the investor's capital is included. Pre-money is about timing. It has nothing to do with revenue level or profitability. Post-money valuation. Post-money valuation is simply the pre-money valuation plus the investment amount. If your company is valued at $4 million pre-money and an investor invests $1 million, the post-money valuation becomes $5 million. The investor now owns $1 million divided by $5 million, which equals 20%. Pre-money determines ownership exchange. Post-money reflects total company value after investment. Enterprise value. Enterprise value represents the total value of the business, including debt. It is often used in acquisitions. Enterprise value equals equity value plus debt minus cash. If a company has significant debt, enterprise value may be higher than equity value. Enterprise value reflects the total economic value of the company, not just the shareholder portion. Equity value. Equity value is the value attributable to shareholders. If a company has no debt, enterprise value and equity value are the same. But if the company has loans or bonds, equity value will usually be lower than enterprise value. In simple terms, enterprise value includes debt. Equity value reflects ownership value. Fair market value. Fair market value is the price a willing buyer and willing seller would agree upon in an arm's-length transaction. It is often used for tax, regulatory, and accounting purposes. Fair market value reflects market conditions, not just internal projections. Part 2. Revenue and profit terms. Now let's move to financial performance terms, which directly influence valuation. Revenue is the total income generated from selling goods or services before expenses. If a company sells $1 million worth of products, that is revenue. Revenue does not equal profit. It is the top line of the income statement. Gross profit. Gross profit equals revenue minus the direct costs of producing goods or services. If revenue is $1 million and the cost of goods sold is $600,000, gross profit is $400,000. Gross profit reflects basic operational efficiency. Operating profit is what remains after subtracting operating expenses such as salaries, rent, marketing, and administration. It shows how profitable the core business operations are before interest and taxes. EBITDA. EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is commonly used by investors to measure operating performance. EBITDA removes financing decisions, tax structure, accounting depreciation. This makes it easier to compare companies across industries and countries. Investors often apply EBITDA multiples to value mature businesses. Net income. Net income is the final profit after all expenses, taxes, and interest are deducted. It is often called the bottom line. While important, investors sometimes focus more on EBITDA because net income can be influenced by accounting and financing structure. Annual recurring revenue. Annual recurring revenue, often referred to as ARR, is commonly used in subscription-based businesses. It represents predictable, recurring revenue expected over a 12-month period. For example, if a software company generates $100,000 per month in subscription revenue, its annual recurring revenue would be approximately $1.2 million. ARR is often used as the basis for revenue multiples in technology companies. Part 3. Company stage terms. Now let's clarify business stage terminology. Pre-revenue means the company has not yet generated income from customers. It may have an idea, a prototype, a product in development, early users without payment. Pre-revenue describes stage, not valuation timing. A company can be pre-revenue and still have a pre-money valuation. Seed stage. Seed stage refers to early development, often with limited revenue and early traction. Investments at this stage are typically used for product development and market validation. Series A. Series A usually follows seed stage and involves scaling operations, expanding teams, and accelerating growth. At this stage, revenue metrics and growth rates become more important in valuation. Mature or established business. A mature business typically has stable revenue, established operations, and predictable cash flow. Valuation at this stage often relies on EBITDA, multiples, and discounted cash flow analysis. Why these terms matter. Understanding terminology improves negotiation clarity, valuation credibility, investor communication, strategic decision-making. Confusing pre-money with pre-revenue can lead to misunderstanding. Confusing revenue with profit can distort valuation expectations. Confusing enterprise value with equity value can affect acquisition pricing discussions. Precision matters. Practical example. Imagine a company generating $2 million in revenue with $500,000 in EBITDA. An investor may apply an EBITDA multiple of 8 times. That suggests an enterprise value of $4 million. If the company has $1 million in debt, the equity value would be approximately $3 million. Now, if an investor invests $1 million at a $3 million pre-money valuation, the post-money valuation becomes $4 million. Each term connects logically. Understanding them prevents costly mistakes. Final thoughts. Valuation language is not complicated, but it must be precise. Pre-money refers to timing. Pre-revenue refers to stage. Enterprise value includes debt. Equity value belongs to shareholders. Revenue is not profit. EBITDA measures operational performance. ARR measures recurring revenue. Clarity in terminology leads to clarity in valuation. If you'd like to explore how these metrics apply to your own company, you can use structured valuation tools at www.valuationforyou.com. And if this video was helpful, subscribe for more clear guidance on business valuation and financial strategy.